Hello, everybody. This is Mike from Your Car Dealer Bond. A question I always get is about dealer insurance. Quite a few people end up asking, what dealer insurance, how much should it cost? If you really had to nail this price down, what would you say? How much would you say it should run me a year? Give me a range. They always tell me that. Give me a range. Tell me about from what to what it should be. And there's so many different factors. That's why it's a 10-page app, but there's so many different factors. Let me just rattle off a few of them that all go into pricing out your used car dealer insurance in 2019, let's say in particular, let's say California. How many drivers do you have? We've talked about this in some other podcast episodes of the Your Car Dealer podcast, but we've talked about specifically how many drivers, age of drivers, full-time, part-time. What exactly is it that they're doing for you? Is it that they're a lot boy, or is it that they're a sales manager, or is it that they're a salesperson, right? Usually carriers have different price points depending on how, what they're doing in the business. What these people are doing, how often they're doing it, that's the full-time, part-time. Their driving records, that's kind of an assessment of their risk, and then how old they are. So really those four factors, if you think about it, in terms of the people touching the vehicles. Now, how many vehicles? Not necessarily a number, but more of a value of inventory. $50,000, $100,000. We're talking on a wholesale basis. These values are going to be on a wholesale basis. We're also talking about including your reconditioning costs. So this is one of the biggest things, the biggest challenges that we constantly see in the realm of an insurance claim, year over year over year. If your car gets stolen, if it gets torched, if it gets vandalized, you get in a car accident, you name it, you're going to have the same. 9 times out of 10, you're going to have a dealer that's pretty upset because of the valuation of that vehicle. When they come down and they say, okay, here's how much this is how much your claim is worth, and they're going to give you a number, right? And that number, the dealer says, hey man, they're going to ask you, okay, forget the rest of your inventory. Let's imagine that you have no co-insurance penalties to pay because you're properly insuring your inventory. So let's assume that you had $100,000 worth of vehicles and you had $100,000 worth of insurance. No problems there. So there's no penalties involved besides your deductible, which is standard. You have either a $500 or $1,000 deductible, and of course, the higher the deductible, the slightly cheaper your rate will be. So imagine that you have a deductible in place, so that means you're going to pay the first amount of money. So the first $500 or the first $1,000 you're going to pay. It's going to come out of your pocket. You're going to be first dollar, is what they call that. So you're going to come out of pocket. Let's say that you bought a $3,000 car. You put in $1,000 worth of recon into it. So you're into this thing for $4,000. Okay, start to finish, top to bottom, right here. Here and now, get this thing on the road. You're in it for $4,000. You're going to sell it for $6,000. It's a beautiful vehicle. You got quite a stunning deal on it. You got some great reconditioning. You put in a couple of aftermarket accessories or whatever have you. Whatever you did to it, you think you're going to get $6,000. And that's on the low end. You think it could go as high as $62,000. When they put in this claim, you're not going to end up with expected profit. Right? That's expected profit is you thinking that they owe you for the amount of money you were going to sell that for, which ain't going to happen. They're not going to pay you whatever you think you're going to end up selling that for. They're only going to pay you for your actual loss. The actual loss is what you were out, that $3,000 that you paid for it, plus $1,000 in recon. That's how much you're out. You're out $4,000. Now you pony up the first $1,000. Now they're writing you a check for $3,000. $3,000. That's what you're getting a check for. You pay the first $1,000 deductible. You're out $3,000 for the cost of the car, $1,000 for the reconditioning. That's what you're out. Even if you were going to sell it for $6,000. Doesn't matter. You could have gotten yourself a Mercedes for that amount of money and turn around, you're going to sell it for 20. If it gets stolen in the meantime, or you get in a car accident in the meantime, that's out the door. All that expected profit you're ready to sink your teeth into, that just evaporated the second that claim happens. Right? So looking at those things inventory-wise, so those are kind of the parameters of who's touching the vehicle, driving records, of course your losses, but imagining that you don't have any losses in your past, you don't have any claims that have happened on your insurance policy. So imagine that there's no actual claims. Okay, good. Now what? Now how much? Now what are we talking about? Right? And so now they're going to look at things like they're going to look at elements like, okay, now how much risk, or how many years have you actually bought insurance? Have you bought insurance for a year, 2 years, 5 years? How long have you had insurance without these claims? Or even if you've had a claim, you've had a $5,000 fender bender, but you pay $5,000 a year. You've been insured 3 years. Well, you've got a 33% loss ratio at that point. You've paid they've paid 5, you paid 15. Right? So for every dollar they've taken in of yours, they've paid out 33 cents in claims. For insurance, it's a great loss ratio. So you'd probably end up with a good quote for that, a discount for that. Now, if it's the other way around, for every dollar they're taking in, they're paying out 80 cents, they're paying out 60 cents on that dollar for your claims. They're going to hold that against you. They're going to increase your rates. You may become uninsurable during that process. They may only insure you with majorly high deductibles. Like you pay the first $5,000 of any claim that happens, right? That kind of thing. Instead of $1,000, you're going to pay $5,000 if any type of claim happens, because they think you're a time bomb. Right, so all these things are going to go into and factor into what this rate is going to be that they're going to end up at the end of the day quoting you, which is why you guys keep on complaining that it's so expensive. Why is it so expensive? Why am I getting rated for so much? Because there's so many different factors that are going into this, not just your drivers and how much inventory you have. Well, then it stops off into another bucket of, oh, you've been in business 5 years and never had insurance and now you want it? Oh, interesting. That's real interesting from the insurance company's point of view. They're looking at you going, wow, this is, they're not looking at you in a good way at that point.